Thanks everybody for sticking around and coming to learn about at least our perspective on the effects of rising interest rates on the M&A environment. As you mentioned, I'm LAMAR Stanley. I'm with Lead Capital Partners. We are a healthcare-focused private equity firm based in Nashville. And I'm also on the advisory committee for AM&AA and as well as the conference committee. So back in April, we started discussing what would be the relevant topics to be having in July as a part of the programming schedule at this conference. And at the time, if you recall, the Fed had just raised interest rates in March by a quarter point. And so we pointed to that and we said, look, that's probably going to be important as we move further into the year, because at the time, the Fed chairman, Jerome Powell, had mentioned, or he at least signaled, that the further rate spikes would be coming. And turns out he wasn't lying, because again, in May, he increased rates by another half point, and then last month in June, he raised by 3/4 of a point. So while that's not great news, I don't think anyone in here is particularly excited about that. I at least am proud to say that the programming committee nailed one, and we got the topical point. We predicted our shot back in April. So anyway, with that, we realized that we wanted to fill this panel with experts both in the lending environment as well as the private equity environment. So that's these guys here. Joining me today is ABHAY PATEL with Lafayette Square Capital, Tim Henry with Harbert Credit Solutions, and then John Dalton with Industrial Device Investments. I always get IDI. I always forget what that means. But anyway, I'll let these guys, they'll do a better job of introducing themselves. And if I were to introduce them using their bios, I would take unnecessary shots at their various alma maters across the SEC. So with that, I'll pass to Abhay.
Go Tigers. ABHAY PATEL, good to be with you. Grew up in Mississippi. I'm based in New Orleans now. As an LSU grad, it's my ties to the state. Spent most of my career in New York in investment banking with Deutsche Bank. Been in New Orleans for 10 years and split my time in the public and private sector. And on the private sector side, primarily focused on the lower and middle market, working with advising companies on selling into basically liquidity events. And I joined Lafayette Square in October, and we are a private credit fund, non-bank lender, focused on backing companies with $10 million in EBITDA and up, generally industry agnostic. We are an impact fund, broadly defined, so we love founder-owned and operated companies, and we like to focus in undercapitalized markets across the country.
Good afternoon. My name's Tim Henry. A little bit of background myself. Grew up in Charlotte. Went to Vanderbilt. First part of my career spent investment banking M&A with Harris Williams. Did startup for a few years, and then I've been with Harbert Credit Solutions for the last about 6.5. Harbert Credit Solutions is one of 11 strategies within Harbert Management Corp, which is based in Birmingham, Alabama. It's a large alternative asset manager with about $8 billion under management. Harbert Credit Solutions Fund, which has been around about 25 years. We invest anywhere from $5 to $15 million, lower middle market companies, primarily with junior capital, so subordinated debt and preferred equity. Kind of have a long history of working with independent sponsors and alongside SBICs or like-minded funds. So.
Hi, I'm John Dalton with Industrial Device Investments. So I describe us as a private equity fund when I want to sound aggressive, and as a family office when I want to sound friendly. So at this crowd, I'll choose friendly and go with the family office. We like to say we're operators who happen to invest, so we're primarily focused on actually being able to help the companies we invest in at the operating level. We invest only in small industrial product companies, so small to us is 5 to 15 million in revenue and 1 to 3 million in EBITDA for our control investments. We go larger with partners with private equity funds. And industrial products is usually manufacturers of sensors, devices, equipment, lab instruments, that kinds of stuff, sold to larger companies. So we are literally a family. My wife is sitting right over there. She helps with the family business. And our roots of the capital come from a family. My dad was an entrepreneur and bought his business when I was in junior high school, and I had to cut the grass and paint the building and mend the fence. I was thankful later that generated capital, so he was an unsecured lender to my parent entity for a while, and that worked out quite well. I was thankful for that. We bought our first company in 2006, and then formed the fund officially in 2017, and then acquired 2 other companies later.
Well, John, I'll kick us off and kick it right back to you and just say, what are you seeing now, reflecting on the 3 interest rate spikes and then as well the inflation report on Monday? How's the market changed to you in the last few months?
So I would say in general, not really at all. I do think there is some ripple of the interest effects, and the numbers in the model have changed. You're putting in a different number for your assumed interest rate looking out. Overall, there's certainly a wariness that interest rates are going up, going to continue to go up. I think that's probably a trend that'll continue. There's an article in yesterday's Wall Street Journal about that. And there's sort of a conservatism around the debt markets now that wasn't there a year ago. So I think there's some emotional differences. Haven't seen a lot of actual hardcore financial differences as of yet.
Have you guys, he reflected on the debt markets getting a little bit more conservative. You seeing the same?
Yeah, I mean, look, I think there's a shift on focus with respect to industries. I mean, I think a lot of us say that we're industry agnostic, but no one wants anything that moves like this. I think anything with consumer orientation is probably DOA today. And I think what you're seeing, not as much on the interest rate side, we're a cash flow lender. Our clients love the structural flexibility, no personal guarantees and no mandatory amortization. So the cash savings without amortization offset increases in the interest rate. So we don't think the interest rate rise will have an impact on our market from a lending perspective, but we are going to see committees be more conservative with respect to leverage multiples, and you'll see a narrowing focus on sectors.
Well, that's a good segue. You mentioned industries or parts of the market that are going to get a little less attractive as we stare down increasing interest rates. Tim, anywhere that you're seeing things get less popular or more popular as we stare that down?
Yeah, sure. I mean, just to piggyback off these guys, I think interest rates isn't, the effect of interest rates isn't have a huge impact at this point. I think we're still trying to figure out COVID. With the labor shortage and supply chain disruption, this seems to be the case, the challenge for most industries. We've grown more accustomed to it, better at underwriting those factors. But in terms of segments, just being in Nashville, we see a lot of healthcare deals. So we think healthcare is still a very strong industry. Kind of B2B business services is obviously doing well with corporate profits at an all-time high. And any segment that can pass on these price increases. So even, manufacturing companies, I'm sure you see this a lot, with rising raw material prices, a lot of these companies that have stayed ahead of price increases are continue to do well and maintain margins. So those are some of the things that we're looking for.
Which is maybe a factor of 10 or 20 more important than the interest rate rise, is being able to manage your raw materials in a manufacturing company in this environment.
Well, on that note, just because we do talk to a lot of business owners that are struggling with supply chain issues and raw material, are we seeing, and I'll push this one that way, deal flow affected by owners' kind of preparedness to come to market, or what have you seen over the past few months in terms of just deal flow in general?
Yeah, deal flow has stayed steady. Folks that are looking for liquidity events, we're seeing a lot in the ESOP space. We love ESOPs. We think those are inherently impactful if structured correctly. So we're seeing momentum there. We are seeing a lot in the healthcare space right now, but across industries. And I'll tell you that more than supply chain, I think a lot of these companies have stayed in front of them, to your point, and supply chain and built up inventory, which is good. Now, if it continues to move out of control, how far in advance can you stay in front of it? We'll see. But, and even more than inflation, where we're seeing the most pain points across our companies that we talk to or that we've invested in is workforce. We are currently working with a manufacturer that's been around for 75 years. They're in the Northeast, auto supplier and heavy truck supplier. They are the largest employer in their town, one of the largest in their region. They've got 100 openings right now that they can't fill. And they've got backlog for the next 2 years. And we, at Lafayette Square, I failed to mention, I mean, part of our impact thesis is, along with our capital, we have a team that addresses sort of workforce attraction and retention. So if we invest in a business, we have partnership today with 15 plus profit and nonprofit businesses that provide sort of extended benefits for employees. So zero interest loans up to $1,000, which prevents an employee from going to a payday lender, small dollar 401k match programs. Anyway, we offer these at no cost to our borrowers. And the thesis there is, hey, we help you with workforce attraction and retention. Your workforce is more stable. They're ultimately more productive, which makes our credit better. But workforce to us is far and away the pain point that we hear the most about.
Same for you guys?
Yeah, absolutely. We have a company that's growing quite a lot in New Hampshire, and we were having a lot of troubles staffing a variety of positions in the org chart. And finally, we put a recruiting firm on retainer for even hiring people on the floor. So welders and manufacturers, he was helping us, kind of round out that strategy. Instead of having the department manager try to do that, and he couldn't survive there, then we had a recruiter that was really helping there to do that, and we've never done anything like that before.
Do you get a sense, in light of the proactive nature of how you're trying to address it, is it trending down or up, or where are you? Are we still in early innings?
Yeah, I think it's not quite as bad as it was maybe 3 months ago. I mean, it's eased a little bit. That's my perception. I have no data behind that, but that's my perception. But it's still, kind of, if you got a top 10 list, it's 3 or 4 of them is the hires that you can't make.
I think we're early, and I'll tell you that workforce was an issue 10, 15 years ago. It's just gotten worse in the last 2 or 3 years. So it was something that we were grappling with as a country for a long time. We didn't have any answers a decade ago. I don't think we have any clear answers today. If folks aren't willing to come back into the workforce, the only thing you can really point to now, based on industry, but is automation is the substitute, which fundamentally I don't think helps the economy.
I do want to come back to the workforce solution discussion and kind of how some of the things that you guys do to make your senior loans a little bit better and better asset. But before we move away from kind of rates specifically, I want to talk to Tim. Are you seeing your product become more or less attractive as interest rates kind of climb towards your way?
Yeah, I think, specific to our strategy, we've been around for 25 years. So, we primarily deal with lower middle market companies that are asset light. So if they want to go raise debt, it's hard to find senior, and they don't want to deal with dilution. So in terms of our pricing, it's remained pretty consistent over the past 25 years. I think obviously our capital is going to become, I guess you could say, less unattractive as the delta between senior and junior capital decreases. I think some people might see us, I don't know how much truth there is to this, but almost see us a hedge against rising interest rates, right? So we're a fixed rate product, so you know exactly what you're going to get, what you're going to have to pay for the 5 years, and we're not amortizing, right? So you're able to really understand what you're getting into up front. So pricing has remained consistent for us and still attractive in the right situation. So,
is your mix of clients coming to see you guys changing at all, or is it holding steady?
In terms of just like total deal flow, yeah, it hasn't picked up yet, but I'm sure it will as rates increase. It's historically that's been the case. So, yeah.
John, do you have something, or?
I've never heard of sub-debt as a hedge on interest rates, but I think that's an interesting concept to stabilize and to be able to use within the business plan, kind of what your whole layout is for the 5 years. That definitely makes sense. Deal flow, our deal flow is very strong. I think there's a lot of these the slug of retiring people is continuing to realize that they need to figure out what they're going to do, now that they're 70. Do they want to retire? And that seems to be pushing most of that market activity at the lower end where we operate, the smaller companies.
I'll echo that and give our own little anecdotes, but deal flow for us in 2021 was the best it had ever been. Early 22 it dipped, but I only attributed that to everyone being exhausted at the end of 21. And then it came back quickly, and that's the common refrain, and that's the only reason I want to jump in here, is that we're hearing from a lot of business owners that are just tired, and they had a 5-year plan. It became a 1-year plan just because they're having trouble hiring people. They're having trouble, buying things in the supply chain, and so consequently, those deals are coming to market that might not have come last year. All right, getting back to the workforce management piece, I know that's another struggle as I talk about business owners being tired and having trouble finding employees. Can you talk a little bit about kind of the lending impact decisions around hiring and firing or managing workforce? You alluded this a little bit about some of the solutions you provide business owners, but
Well, I think first and foremost, just from a credit perspective or an investment perspective, any product, if you're telling me you've got 100 open positions and you're giving me a forecast, I don't know how you're going to hit your numbers if you don't have the people. So I think fundamentally, you've got to now model in the ability to, not capacity from a manufacturing perspective, but from an execution perspective around personnel. We're trying to be proactive in that space because we hear so much about workforce being a pain point across industries. I mean, rural healthcare, QSRs, manufacturing, it really doesn't matter. Any sort of labor-intensive industry today has issues, from senior level employees all the way down. And so, our founding team said, look, if these are the kinds of businesses we want to support, how can we do that beyond just the capital? And how can we be more present day to day from an operating perspective without interfering with them, just complementing? And so we go in, we connect with the HR team. Sometimes it's 1 or 2 people. Sometimes it's a broader team. And say, well, tell us the profile of your employee. Give us a sense of the benefits that you offer. Here's a portfolio of benefits that we can complement your offering with, and let's see if that works. And I can tell you, we're early. We're at 18 months into this thesis. We've made a handful of investments, but the receptivity of our companies and our ability to sort of differentiate the market with the workforce component so far has been real. And the adoption of these benefits across our portfolio companies has also been meaningful. It's just incredible when you think about it. I mean, Lamar grew up in Mississippi. We're all here in the South. I mean, the number of payday lenders in this part of the country. I mean, you drive half a mile and you cross 3 of them, and folks that just need $300, $400, $500 are taking a half a day to go to the payday lender to take care of a sick kid or flat tire, whatever it might be. I mean, these are real problems. From an employer perspective, if I can address that, then I can make my employees a little bit more stable and a little bit more productive, we hope, right? That's the idea, and we'll see over time if that's how it works. We need more folks than just one firm doing it. But
and are you guys winning any business with that offering, or is this just something you're offering to existing clients?
Huge differentiator for us. When we get into a competitive situation, our ability to bring that workforce team into the conversation and to let the employer know that we offset the expense. I mean, the employer pays for it, and then we reduce the interest rate dollar for dollar, usually more, so they never come out of pocket for that. And that's a game changer for a lot of folks.
All right, John. So a lot of people like me complain about just multiples, particularly around healthcare, where Tim has a lot of experience. Just they haven't budged. Theoretically, money has gotten more expensive, and yet multiples continue to move up. My hypothesis is that just how much dry powder out there is what's impacting that. What's your sense? Do you agree with that?
Yeah, and I mean, there is so much capital ready to come into the middle market. I mean, it's like a knife fight at a cocktail party. It is not. There's just so much ready competition for $3 million and up EBITDA deals. You may be, I mean, in healthcare you probably see all different sizes, but in those larger companies there's so much capital that is ready to come into the market. Strategics had pulled back, it seemed like, for a while, with COVID and wanting to understand their business plan. That is no longer the case. There's a lot of strategics on the market, and private equity. It's a bonanza of capital available. I'm not sure even the slug of retirements that are coming can support the capital that's out there. Somebody's going to have to, give their money back. There's just no way they can spend it all. It doesn't seem like it.
Same sense for you guys?
Yeah, absolutely. I mean, you'd think that in the long term that interest rates start at zero and they're starting to climb, and valuations have been at all-time high. That that inverse relationship would start to kick in, but we're just not seeing it yet.
And private equity people are crazy. They're going to find a way to model around higher interest rates.
Well, segueing from that, just finding ways, because I agree with you 100%. I do feel like
We're a family office.
that's a good point. You're not talking about yourself. Yeah, so, but I do feel like private equity firms will retreat to the places that they're most comfortable. So if you've had success in a certain industry or sector, that's where you're going to be spending your time in light of the kind of market oscillations. Do you guys, I'll start with that, feel like there are any places where you're seeing people drive down deeper due to industry expertise, or are there any areas where you anticipate folks trying to dig in a little more?
Yeah, I mean, look, I think it's emerging as a theme on this panel of where a lot of deal flow is going to be in the near term. It's healthcare. I mean, the amount of healthcare deal flow we're seeing, I mean, it's outpacing every other industry. What I would say, I mean, I think you're right fundamentally that folks that have expertise in a specific area will move towards that as they're allocating capital. But another dynamic we're seeing though are people abandoning industries, right? I mean, we had two large deals that we were looking at. One was an acquisition of a number of 50 Subway franchises. That deal got pulled. Another fast food chain, Bojangles, that one got pulled. So we're seeing more fleeing. Where are those folks going? Probably one to areas where they're most comfortable, but also to safer industries. And healthcare, again, seems to be that place that we're sensing that capital starting to go.
Interesting. So less about where people are diving into and more about where they're protecting against.
Yeah.
Are you speaking to the private equity? Because I feel like I've heard a lot of stories where senior lenders, like large commercial senior lenders, are saying, "Listen, we got to decrease our exposure. You guys need to refinance us out." Are you seeing that in any of your?
We have not. So
Yeah.
I think we compete against permanent capital solutions, and so there's more patience there because you're looking at it from the long term. I think you're right. As you go upstream, though, if we're focused at 10 to 25 million of EBITDA, anything over that 25 market, yeah, I mean, when we're talking to potential syndication partners, I mean, their credit box is so tight. They're putting a lot of pressure on their portfolio companies that they've invested in. In our end of the market, we're not seeing it as much just because we're trying to make long-term plays.
Yeah, we're starting to see a couple opportunities come up through those dynamics, so it's interesting.
Yeah, I mean, I think what'll be interesting if anybody's seeing this, I mean, as the banks continue to get squeezed, one, they're squeezed based on regulations, right? I mean, that's what's allowed folks like us to have capital and to deploy it. But as interest rates continue to rise, I mean, it's hard for traditional banks to compete as it is. How can they compete in a rising rate environment? That, in theory, should push more deal flow into the market.
You think that healthcare deal flow is COVID rebound related, or is that more of a permanent opportunity?
Yeah, I think it's a little bit of both. I do see, we've seen a glut of deals around urgent care, lab services, all the things that you can kind of tertiarily touch back to COVID. So urgent cares, there's a strong contingent of intermediaries pitching these deals, and they say, look, this is not a COVID bump. This is people who found their doctor during the COVID era. And I think there's some truth to that in rural communities, but in urban areas like Nashville, me, for example, I went and got 2 COVID tests at an urgent care center at some point over the past 2 years, and I'm probably never walking back in there. So there's the COVID pop. But I think there's a case for some of those deals that we're seeing that are trying to capture some of that COVID pop, that there is some legitimacy to continuation of that cash flow.
Yeah, and if you think about some of the other subsegments within healthcare, a lot of those segments bounce back really quickly. I mean, shut down for 6 weeks, and now they're back open. I mean, if you think about dermatology, dental, some of the large PE plays, I mean, they were down for a couple months, and then they've, back to either pre-COVID volumes or higher. So hopefully you think it'd be a long-term permanent. So,
we've got a deal in every space you just mentioned right now. I mean, there's a rural healthcare deal that we're looking at, the lab services deal. In fact, we're going to close on a dermatology deal here in a couple of weeks. So it seems to be just spread.
Yeah.
Let me ask you, Lamar, let me ask you a question just while we're on this topic, because I think the consensus here is that so far we haven't seen any real impact from an interest rate rise. So that turns your attention to how much leverage you're going to put on a business relative to valuation, right? So you mentioned earlier that the healthcare valuations just continue to kind of either stay up or grow, but as leverage restraints lock in, how do you think that'll
This is totally off script, by the way.
impact?
I think and I'll be interested to hear how John is going to address it, but the answer for us is pretty simple. We'll just over-equitize. We're just going to, because what we don't want to do is hamstring the management teams that we're backing to, make it a little bit tighter and a little bit more of a tightrope they got to walk. The only other thing is maybe we look at it after a year and try and get back to leverage ratios that we had kind of pre this era. But I think that's our answer in the near term. And not to mention too, I mean, we were users of Tim's product in the past, and so being able to stabilize and lock in your rate has been pretty useful for us to be able to predict the future when nothing else is predictable. So, John.
Yeah, that's definitely adding some equity is the logical first step of impact on as interest rates rise, and so that may be necessary.
Yeah, what we've done, we've at least been requested. A lot of the deals that we're seeing is, like you mentioned, to kind of over-equitize at the start, but as attached to the loan agreement, have kind of a delayed draw mechanism, right? So, as things improve, to know that gives the company some comfort that they have access to debt, and the docs are already figured out. So, just a kind of a interesting, yeah.
On that note, any changes to the way you guys are underwriting, kind of when you're looking at deals over the past, call it 6 months?
I would say in the last 6 weeks, we're really, I think it's notched down a multiple from a leverage capacity. Everything's up a point to a point and a quarter on the interest rate side, for sure. And again, I think it's more a process of eliminating industries that we're just not right now going to be comfortable going into. So anything that's consumer facing, as I mentioned earlier.
Yeah, I think when you think about our underwriting process, I mean, COVID really shifted how we approach our underwriting process. It seems like we just become more accustomed to some of the risks that, historically, we would turn our nose up at. And I think, it's an interesting situation because the position we're in right now it seems like it's a demand-driven, it's a supply-driven recession, right? So, like, I'm not sure if this necessarily is a recession, if we are going to go into a recession, anything that we've ever seen. So I think we're okay taking that upfront risk with the idea that the demand is there. People, at least up to this point. So I think on the diligence side, we're looking more heavily at management teams, right? So if we're going to go kind of through a little bit of a rough patch, we want a really strong management team that can navigate that. And to your point earlier, just putting more equity in and having some type of delayed draw mechanism to increase the leverage ratios.
We like strong management teams in all economies. But yeah, I think I agree. It's even more important. When we hit COVID, everybody has their eyes kind of wide open about what's going to happen because we'd never seen anything like that before. And so it wasn't so much underwriting at that point. It was kind of bearing down on how do you protect your portfolio company and what do you do to maintain the health of the company in a situation you'd never seen. And that was definitely very different. I think that realizing that could happen is a difference in the underwriting just by itself.
Well, we've all kind of talked about cautiously kind of moving over equitizing deals and moving slowly into new deals as we look into the next 6 months. But this question specifically for John, because I've heard you say, you're not a market timer before, but do you expect people to hold things longer or kind of look at continuation opportunities, or what's your sense around that?
Yeah, my hope is that all the investors in private equity demand their money, and that they can't extend those hold periods, because that's one of the ways we compete. So we're delighted for those general partners to demand their money back. I don't think private equity would change that much in a rising interest rate environment. That's a pretty entrenched 5 to 7 years. We've owned our first company. I bought it in 2006, so 16 years, and there were times I should have sold. I didn't recognize it far enough ahead enough to take advantage of that wave and capitalize on that. And it's having gone through a turnaround now with that company that generated a bunch of capital. That's maybe a poor decision to hold, but nonetheless that will generate capital again, and it'll be back. So we're pleased with that opportunity, even with a company that went through the ringer. So I think that's that holding period for me is a sort of a non-issue. We talk about it a lot when we talk to owners as a differentiating point. It's not that we wouldn't sell anything; it's just that we haven't.
Any sense for that with you guys in terms of seeing exits slow, or secondaries, or continuation funds, or anything like that?
Yeah, not necessarily. Yeah.
I think it's a little early, but I'm just basing this on headlines in the Wall Street Journal, but I do feel like the preponderance of continuation funds is increasing. And I don't know if that's just a trend in terms of general private equity behaviors, or if it's actually an effect of what we're seeing in terms of interest rates increasing. But
yeah, I mean, if you think about it, a lot of the funds have deployed 5 years capital within 18 months. So at least 2021 and end of 2020. So hopefully there's a little more patience around deploying capital here in the future.
All right, now the hard questions. John, are we going into a recession?
I think LAMAR is picking on me. Does everybody agree with that? No, I don't think we're going into a recession. I see, we study the industrial markets extensively. You look at simple metrics like the Purchasing Manager Index, still above 55. People are buying capital equipment. They're buying materials for their processes. The manufacturing environment is very robust. If your industrial companies have not done well this year, you are screwed, because this is the time you can do well in industrial companies. So I think I don't think we're headed to a recession. I think maybe a more moderated expansion, if that's a economic term. I think I might have made it up, but I think there's still sort of a level to slight expansion that'll continue. I don't think we'll see a recession for a while.
What about you guys?
Go ahead.
Yeah, I mean, I don't know. I'm not an economist, but I'll say this: whether we have a recession or not, we've never had a confluence of factors like we're seeing. So I don't know how any academic can predict. And what does a recession even look like? I mean, we had the Great Recession followed by the longest economic expansion that we've had, that got halted only by a global pandemic, unprecedented federal spending into that pandemic, and then externalities on a global scale that are impacting us from China to Ukraine. Folks smarter than me maybe have modeled all that and figured out what it looks like. I doubt it. Not because there aren't folks smarter than me. I just don't know how you can account for all those things. So whether we're in a recession or not, I don't think it really matters. I think the question is, and I don't have an answer for it, is what does the next handful of years look like? And I think with the capital that's out there, with the dynamic of an aging population that wants to continue to move to exit businesses and retire, the continued sort of segmentation of the lower middle market, the middle market, and then your capital markets, I just think we have a whole bunch of answers that we'll find out about over the coming years.
Tim, any predictions?
No, I'm with John. I mean, I still think the demand's there. Companies are still hiring. I think there's 11 million open jobs right now. So, as people are looking for work, you think they'd be able to find it, find the wages, and create the demand. So, yeah.
All right. Well, I have a handful of other questions, but before I'm watching my shot clock wind down here, and so I wanted to open it up in case any others had any questions or ideas, something to talk about. Yeah. Well, what do you think, and this for anyone, less relevant for you, John, but fundraising, what do you think the impact of increase in rates will be towards fundraising for groups like mine, frankly? Tim, any ideas?
Yeah, you know, I was having a conversation with somebody the other day, and I think it's more has to do, you know, our fundraising. You think about if we go to, you know, LPs, they're looking at their portfolio and stocks are so far down, you know, their equities are so far down that their debt looks, you know, their debt piece looks almost overextended. And, you know, I'm not sure if that's going to be the case as we're out raising our next fund, but if people have the, you know, appetite to bring on more debt as part of their portfolio, something to think about.
I mean, we're actively fundraising. You know, as a new fund, we're raising and deploying at the same time. It's getting tougher. I don't think there's any question about it.
Do you attribute that to just denominator effect, pies getting smaller, just due to stock market portfolios?
Yeah, I mean, I think folks are just trying to figure out what the market's going to be and how to shift allocation.
Yeah. I've seen the same thing, and talking to, I just on occasion have conversations with placement agents, and they've said the same thing. Just between re-ups, you know, a lot of capital is already accounted for, and due to that, people are a little bit hesitant to, you know, deploy capital in new places and that type of thing. So with that, I don't want to clog things up unless anyone has anything, questions, but I really appreciate everybody hanging around, and thank you to the panel for jumping on board, but thank you all for hanging around.
Thanks, Lamar.
Thanks, everybody. Thanks, Lamar.
Corbus, yeah.